This is a free trade agreement with New Zealand, which is both comprehensive and forward-looking, reflecting the vision of our two leaders, Prime Minister Modi and Prime Minister Ellison, to elevate the relations to much higher strategic levels, much more comprehensively.
That's India's Commerce and Industry Minister Piyush Goyal calling the free trade agreement between India and New Zealand a win-win. But some are questioning that claim. Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, dairy accounts for about 30% of New Zealand's exports, so how does it hope to milk an FTA with India that excludes dairy? We'll ask New Zealand's Trade and Investment Minister Todd McClay. We'll also get his take on whether the deal might be a hard sell at home. Well, stocks in Asia extend their two-day gains after bullish momentum lifted Wall Street, indicating that a Santa rally may be taking hold. And billionaire Larry Ellison is providing a personal guarantee of $40 billion in equity financing for his son's bid for Warner Brothers Discovery. Also ahead, China Vanke averts default after winning creditors' support to extend a bond repayment grace period. Let's take a look at how markets are tracking in the Asia-Pacific. It is another broadly risk-on day, modestly so. Some of the gains we're seeing not quite as big as what we had on Monday, but we've got stocks in Australia performing pretty well. We're better by 1.1% at the moment. The Nikkei kind of flat right now. The Kospi better by 0.4%. Modest gains also in Hong Kong. We've got a little bit of strength in the Japanese yen, I say that comparatively speaking, 156.33, and that comes off the back of a warning from Finance Minister Satsuki Katayama saying the country has a free hand to take bold action against some of these outside FX moves. So a warning to speculators there. Crude prices feeling a little bit of pressure, but there's not a huge amount of change on the geopolitical front. And we've got gold continuing to push higher towards new records. But let's get to our top story now with India and New Zealand concluding a free trade agreement that cuts duties on 95% of New Zealand's exports to India. The deal, though, has stopped short of opening India's dairy market, with New Delhi saying that it wanted to protect the interests of its farmers. Now, that's drawing some criticism from dairy giant Fonterra, which calls the pact disappointing. For more, economy and trade reporter Shruti Srivastava joins us now from New Delhi. Shruti, so sorry to stumble on your name there, but do tell us about what the reaction in India has been to this announcement.
So let's first, talk about the deal per se. India-New Zealand Free Trade Agreement is the third pact that India has signed this year. And in terms of traded value of goods, it's a pretty small, FTA that way. The bilateral trade between the two nations was just $1.5 billion last year. So in terms of, the economic impact of the trade, it's a very small deal. But in terms of signaling, I think the signaling has been very strong from the Modi government, which has come under intense criticism from the US for its high trade barriers and tariff duties. So this signals that New Delhi is liberalizing its trade policies. It's bringing down trade and non-trade barriers. That's the first thing in terms of signaling. The second thing which it signifies is that India is looking to increase its economic footprints globally. It's willing to diversify, and this has gained greater urgency right now because India has been hit by a 50% tariff from the Washington side. So its exporters are being pummeled by these high duties and losing market access. That in those terms, this deal is a critical one for New Delhi and the Modi government. So far, the reception has been good. It shows that there is willingness on the government side to bring down trade barriers. However, this also signals that the government is not going to compromise on the red lines it has set with the US as well. For instance, it has not opened the dairy sector for the New Zealand exports. this is a very critical sector for India, politically sensitive. India has millions of small farmers who own less than 2 acres of land, 2 hectares of land. So it has clearly shown that it's not going to compromise on the red lines in the farm sector, in the dairy sector, and this again is a crucial signal from New Delhi.
So you mentioned about how well it's been received in India there, but New Zealand is a very, very small market. Is this more of a symbolic deal from the Indian side?
I would say, economically, as I said, economically it's not going to have major impact. India is a big market. It provides, access to 1.4 billion people of the country for New Zealand. Comparatively, of course, New Zealand is a smaller market, but clearly in terms of, strategic and economic signaling and indication, this is a crucial deal for the Modi government, because see, after the UK, which was signed in May, India wrapped up a deal with Oman last week, which is again a very small deal, and now New Zealand. So 3 pacts have been signed. This clearly shows that the government is engaged with its trading partners. It's in talk with the European Union, and we are being told that maybe by next month that deal would be wrapped up too. So in terms of economic signaling, this is a critical deal for India.
All right, that's our Economy, Trade and Investigating Agencies reporter, Shruti Srivastava there in New Delhi. Well, let's get some more on the New Zealand-India trade deal with New Zealand's Trade Minister, Todd McClay. Minister, thank you so much for joining us today. Obviously, this is a very significant deal for New Zealand, given the relative size of India's economy. Trade at the moment, we're in the ballpark of US about $2.2 billion in the year to September. How do you see this two-way trade growing once the free trade agreement's ratified?
Well, Paul, thanks so much for having me on. And my good friend Piyush Goyal, the Commerce Minister in India, is correct. It is a win-win for both of our countries. It's a very high-quality agreement, as you have said. 95% of New Zealand's exports are covered by some form of liberalisation. And when fully enforced, about 82% of exports will be tariff-free. So we're very pleased with the result. You are right that our trade with India is modest, particularly when you consider the size of India. But New Zealand has a great track record of when we get a trade agreement right and it's balanced of both sides, trade increases very, very quickly. As an example, our FTA with the European Union, which entered into force almost 2 years ago, has been worth an extra $2 billion worth of exports for New Zealand in that period of time. And there are comparisons that can be made between the India FTA and some of the areas that we gained with the EU. So we're optimistic.
So do you have some targets in place for how big you could see that trading relationship get within, say, 5 years or 10 years?
Well, our two prime ministers spoke yesterday before the announcement was made to check in. Of course, Prime Minister Modi and Prime Minister Ellison have been engaged during the time that Minister Goyal and I have been negotiating furiously for just 9 months. It took 9 months to get this deal done. They set a target for us of saying we could double the amount of trade we have over the next 5 or 6 years. And I think that's more than possible. Indeed, if you look at the Australia FTA that was done in 2022, over the first 2 years, the Australian exports grow by almost 130%. So actually, I think that once we get this in force, there are big opportunities for the Indian producers in the New Zealand market, and certainly for New Zealanders who produce high-quality goods and services. We will be working hard as two governments to make sure the benefits of the agreement is delivered both for India and New Zealand.
Well, you mentioned that there's a lot of things, 95% of trade covered in this agreement, but we do have to talk about the 5% that's not, because it is important. Dairy, an obvious omission. But was getting India to come to the table on dairy realistic, considering India's trade minister had said that this was never going to be an option for any free trade pact with anyone?
Well, look, we're aware of the sensitivities and political reality of a lot of the things that New Zealand might produce. You mentioned earlier that, that New Zealand not having as much dairy in the agreement as we'd want is a big challenge. The New Zealand economy is much more than dairy farmers. You are right that dairy is a very big part of our export profile, but to the sheep and beef farmers, or sheep in this case, and to wine and to our services trade, this is equally a valuable agreement. We are pleased in some of the high-value dairy or or dairy adjacent areas, we have been able to make inroads, and our exporters are very pleased about that. But you are right, they would have liked to have seen more. If you take our number one trade relationship, which is China, when we signed a free trade agreement with China more than 20 years ago, our trade was very modest, very similar to the amount of two-way trade we have with India now. All those years forward, it's now 40 billion New Zealand dollars. And if you take dairy out of that equation, China would still be our number one trading partner. And so there is many opportunities in this market very broadly in our economy. But we will keep talking to India, as we do with other trade partners, about the opportunity for greater cooperation, and how that in many areas, including with dairy, we can find ways to cooperate. The value of the dairy production in those countries increases.
Well, is this a possible way? Because I understand there is a fast-track arrangement within this deal allowing Indian manufacturers to import products and then re-export food products. So is this a potential way to get more New Zealand dairy products into India?
Well, it's very interesting, and that's something that our dairy exporters have welcomed, and they see potential there. It will take a little bit of time for them to form those relationships. But you think about India, they are the world's largest dairy producer. They probably have the largest number of dairy farmers, very small number of animals per farm or per farmer, whereas New Zealand is probably in the other direction. And so we know that Indian manufacturers who want to export to around the region, to countries that they have FTAs with and further afield, are looking for the highest quality and highest value dairy in the world, and you don't get many places better than New Zealand when it comes to that. So I think there are some big opportunities there. This free trade agreement is very forward-looking. It's not about the tariff savings on what we may trade at the moment. Our trade is modest. It's about potential and what more can be done. And we know that when we get a trade deal right, we recognise sensitivities on both sides, and we get the balance right, two-way trade grows significantly, and I think we will see nothing but opportunity and achievement in the New Zealand-India FTA in the future.
Well, of course, your government's coalition partner, New Zealand First, its leader Winston Peters, who's also the foreign minister, has said he won't back this deal because it didn't achieve enough. So when it comes to ratifying this and getting it through Parliament, where are you going to go to get the support to get this done, and how confident are you in doing that?
Yeah, look, there are very few people in New Zealand who are surprised by the position that New Zealand First, one of our coalition partners, has taken. They've always had a view of trade and some challenges with it, although Minister Peters is very committed to the relationship with India and building it. Ultimately, for the last decade, trade in New Zealand has been bipartisan. And in the last 2 years, since I've become minister for my second time around, we've had two trade agreements we've put through our parliament, that it has had almost universal support across our parliament. We'll be talking to other political parties and saying that if trade is good to New Zealand, which we all accept, this is a high quality trade deal, and we would want as much support as we can get in our parliament. But as an example, the EU FTA and the UAE FTA, which we passed into law last year, had a super majority in our parliament. Some parties may not like all of this agreement, but I don't believe we'll have a challenge getting this into law.
Well, one of the other sticking points for New Zealand First was changes to student visas, allowing students to work 24 hours per week, to post-study visas of up to 4 years as well. Can you tell us a little bit more about the discussions around that and some of the opposition to it?
Yeah, look, again, there's not a lot of opposition, but different parts of the New Zealand society and political parties will have their own views. From the point of view of the government, and us as the largest party of the government, this is a very common sense approach to our relationship with India. We're a very open economy. We want people from around the world to come to New Zealand and study, and as part of their study, they already have the right to be able to work post-study, to get experience and then return home. In the trade agreement, we've looked at the top end of this. We want more students who might study STEM subjects or masters and PhDs, and we've weighted the work rights post-study in those areas. But it doesn't give anybody a right to migrate to New Zealand, nor do they have any other abilities other than those the government has already decided to offer them. But in the case of PhD students, they'd be allowed to stay in New Zealand post-study and work for 4 years, and then would need to return home. And we think that's good for the economy. Not only will it be good for institutions, these students students will get very high quality degrees, and they will get their experience, their skills used in the New Zealand economy at a time when we need greater skill here.
Well, another element of this deal was a provision for $20 billion worth of private direct investment into India over 15 years. Can you explain to us a little bit more about what that's going to look like?
Yeah, well, we know that there's a lot of investment that flows out of New Zealand, and equally New Zealand attracts investment. I earlier this year was made also Minister for Foreign Direct Investment. We want to attract investment to grow our economy, to partner, and we have a very clear vision. If it's good for New Zealand and good for New Zealanders, we will be saying yes to investment, and so we're working through that. So the FTA recognises that. It sort of sets some targets for us. We want more outward investment from New Zealand. You know, there will be food manufacturers. There were people that want to manufacture in New Zealand and elsewhere around the world, and this is an opportunity for them to look towards India. The Indian government has said they'll be very open and make it easier for New Zealanders and their companies to invest in their economy over those 15 years. It is aspirational, but it is more than achievable. As an example, I've just had an Indian New Zealander who manufactures beds in New Zealand saying he's about to make a $100 million investment in India because he wants to manufacture beds there also for the Indian market and to sell around the world. And so we see this as a win-win, but it's a very clear determination of the two governments to say we are open to trade, we're open to investment, we want it to go in both directions, we want it to be fair and balanced, and we're willing to support the private sector by way of better rules and better direction to achieve this.
So you mentioned the bed manufacturer there. There was also food manufacturing that you mentioned. Are there other private firms or industries that might be looking to get involved in this initiative?
Yeah, very much so. We have a number of companies that are involved in engineering and construction and so on, and they see big opportunities there in the Indian market. You know, I need to offer nothing but praise and congratulations to Prime Minister Modi and his cabinet. You know, I have been visiting India off and on for the last 15 years, and I see in the last few years it being transformed. It is an economy that is growing. It is a population that are confident. They want to go out and play a very positive and active role in the world, and they are building that economy and its infrastructure. And there are New Zealand companies that are active around the world but not in the Indian market yet that will have an opportunity to do this. So this trade agreement sets a common set of rules that businesses on both sides can rely upon, they can trust. The Indian government and the New Zealand government are clear. We will honour the commitments we have made to each other in this agreement, and it gives our business community an opportunity to say, in a world where there is confusion and risk, here are two governments have said we want to commit to building the relationship, and if we go and invest in each other's countries or we trade more and build those relationships, then actually we have greater certainty. I think if you invite Minister Goyal and I back on your show in 5 years' time, we will be talking about the jobs and trade that this agreement has created for both of our countries.
Well, we've already discussed I was a little disappointed that dairy products weren't included in this deal, but there were other things that were included that were a surprise. For example, Apple access. I believe this is the first Indian FTA to allow that. Can you talk to us about the significance of that and any other highlights of the deal that we haven't mentioned yet?
Yeah, that's very important. It's important for New Zealand. We're very innovative when it comes to growing food and food production. If you look at the apples New Zealand has around the world, the prices they receive are better than many other places. You know, in some areas of our economy, food production, we still produce a lot of commodity, but in other areas it is purely about value. And so, you know, very grateful that we've been able to negotiate a seasonal quota for that and for kiwi fruit with the reductions in tariff rates or zero tariff rates. In return, we've also said we want to play our part for Prime Minister Modi meeting his commitment to increase the earnings of Indian farmers by 50% by 2030 or 2035. And so there will be many New Zealanders who go and work with India, with their agricultural ministry, their producers, to find ways to help them be more productive and to improve the quality, the very things that we have done here. You know, trade is not just about, the agricultural trade is not just about food, it is about technology, it it is about know-how, it is about sharing. And so there are a lot of opportunities there. One area that I'm very, very proud of is getting the tariff rate for sheep meat down to zero. Before Australia signed their FTA in 2022, New Zealand was responsible for about 89% of all of the imported sheep meat into India. That's fallen to about 8 or 9%, as Australia is now well into the 90s. The reduction of that tariff rate to zero levels the playing field, and it's very good news for Indian lamb consumers. They're about to have some competition, which means they now get the best lamb in the world from New Zealand, as well as being able to choose Australian should they want.
All right, New Zealand Trade Minister Todd McClay, thank you so much for your time today. Still to come this hour, Larry Ellison throwing his personal fortune behind Paramount's bid for Warner Brothers, aiming to give his son's company an advantage in its takeover battle with Netflix. We'll have details of that coming up. This is Bloomberg. Bank of America CEO Brian Moynihan says the US economy will be strong next year, due in part to companies ramping up their AI investments. He spoke to Bloomberg about the new technology's growing economic benefits.
The AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build out, which is one of the ways it evidences itself, that's a big deal. If you look at client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single digit rate type of number. So I think that's part why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer. And you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
You have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say it in the 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So if we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base, we do see differences, i.e. the higher income and middle income are growing faster, but even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft, and as we look forward at 4.5, 4.6 unemployment, that is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, or 40-year, it's 5 and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape.
Still to come, Japan's finance minister tells Bloomberg exclusively that Japan has a free hand to act against currency speculation. We'll have more from our exclusive interview next. This is Bloomberg. Welcome back. You're watching Insight. Warner Brothers says it will review Paramount's amended offer that's being personally backed by Larry Ellison. The Oracle founder and the world's fifth richest person is aiming to give his son's company an advantage in its takeover battle with Netflix. For more, let's bring in Chris Palmieri, who leads our media and entertainment coverage. So, Chris, is this backing from Larry Ellison going to move the needle here and maybe give Warner Brothers the flexibility that it's looking for?
Well, it certainly puts Warner Brothers in an uncomfortable spot because they wrote a pretty strongly worded letter response to the Ellisons last week, listing all the issues they had. And now here the Ellisons come back with answering a lot of those problems, including this $40 billion backstop from Larry Ellison personally. So I think Warner Brothers board is going to have to really reconsider this, whether it totally changes its mind without a higher bid from the Ellison, that remains to be seen.
Tell us a little bit about how these Paramount and Netflix bids differ and why Warner Brothers seems to be leaning towards Netflix.
Well, a couple of the things that Warner Brothers complained about last week and still haven't been resolved is that Paramount's going to have a lot of debt, more than Netflix would, because Netflix has a stronger balance sheet to begin with. And also that Paramount is projecting a lot higher job cuts. They're looking at something like $9 billion worth of cost savings. Only $2 to $3 billion there is what Netflix is saying. So they pointed to those two things as being troubling about the bid still. Netflix is only buying the streaming and studio business and spinning off the cable networks. Paramount wants to buy the whole company, and there's a dispute about what those cable networks are valued at, and that's really why we're seeing a dispute about whose bid is really higher.
All right, Chris Palmieri, who leads our media and entertainment coverage. Let's just take a quick look at how markets are tracking. Japan coming back online after the lunch break. Was flat when they headed out for lunch. It's still flat now, only better by a few points at the moment. The Kospi better by 0.4%. But we're seeing modest risk-on sentiment everywhere. Even the yen catching a bid. 156, relatively strong compared to where we've been. Why on earth could that be? Well, Japan's finance minister has issued her strongest warning yet to currency speculators, telling Bloomberg that officials have a free hand to take action. Satsuki Katayama spoke to us exclusively in Tokyo.
為替の状況っていうのは必ずしも
Foreign exchange markets don't move only on interest rates or rate differentials. Especially toward the end of the year, around Christmas, trading tends to get thin, and many factors can drive the yen's moves. But the yen's sharp, very short-term movement right as the BOJ governor began his press conference last Friday, that was clearly not in line with fundamentals, but rather speculative. Against such moves, we have made clear that we will take bold action, as stated in the Japan-U.S. finance minister's joint statement.
Now that the Bank of Japan has moved to raise interest rates, the next focus is clearly on whether the government will step in with foreign exchange intervention. How do you see it?
We have
an agreement with the United States that allows us to intervene whenever the yen makes an excessive move. That means we have a free hand.
In the past, a finance official has called a 10 yen move in a little more than a month excessive. So what kind of time frame and magnitude would you consider a sharp or disorderly move? Is there any benchmark you use to assess that?
I can't say definitively whether there's a benchmark or not. I worked closely with currency chiefs during my 20 years at the finance ministry, and I've stayed in close touch with many of those who came after I left. Each situation is different, so it would be wrong to expect the same pattern every time.
Trading tends to thin out around the year-end and New Year period. Is it fair to say that the authorities are fully prepared to respond?
We're always ready to act. That goes without saying.
When it comes to a question of a certain degree of fiscal discipline, there are various ways to interpret that. For example, how much the government relies on bond issuance or how much JGBs it'll issue. Could you share a bit more on how you're thinking about these points?
I can't give you specific numbers, but even after the supplementary budget was passed, we made it clear that the total amount of government bond issuance, which, after all, is what puts pressure on the market,
did not increase. At this time, we're talking about the initial budget for fiscal year 2026. We're confident that it won't be something that places an undue burden on the market either.
There are concerns in the market that Japan's fiscal position may be deteriorating. What message would you like to send in response to those concerns?
それは数字の取り方からすれば積極
By switching to active fiscal policy, we knew before we started that in the first fiscal year, some of the finance numbers would deteriorate. But that isn't the problem. We've spent 10, 20, even 30 years in a situation where economic growth barely picked up no matter what we did. There's no point in just doing the same things as before. We need to make a decisive shift, to concentrate resources and boost our growth potential. I believe we'll see a strong pickup in investment next year. And if you look at projected tax revenues for next year and the year after, I think what looks like fiscal deterioration now will prove to be only temporary.
That's Japanese Finance Minister Satsuki Katayama speaking exclusively with Bloomberg's Takashi Umikawa in Tokyo. Well, our next guest says he's comfortable laying his cards down on buying the yen. Let's get insights from Arthur Budaghyan, Chief EM Strategist at BCA Research. Arthur, thanks so much for joining us. I know you've got an acronym heading into 2026, GOD, get out of the dollar. How much downside are you anticipating for the US dollar, and could the yen be a beneficiary here?
Yes, I believe that year 2026 will be year of get out of the dollar for global institutional investors, and Japanese yen will be one of largest beneficiaries. At least to say that Japanese yen is very cheap. It has been cheap. Again, valuation is not good timing too, but I think we are approaching a kind of a turning point in Japanese yen in global currency markets. And I think next year currencies will stop being driven by interest rate differentials that has been weighing on yen for past several years, and currency will become driven by balance of payments. And balance of payment of Japan, it's not weak. It's on a positive side. Japan running current account surplus. So I believe Japanese yen will appreciate substantially next 12 months.
Would you be willing to put a price target on that if we were to speak again in 1 year's time?
I think 125, it's quite reasonable target.
Okay, so with Minister Katayama saying that they're going to crack down on speculators, defend the currency, are you confident that we've seen the floor in the yen in the near term, or in the next few weeks could there be a little bit more weakness?
Of course, we can have still more weakness in next few weeks. It's very hard to time kind of near-term dynamics, but I believe by end of January we would have seen the weakest point in a yen. So I would not say that weakness in yen will extend beyond next 4 weeks, and then we'll have, as I said, substantial upside to 125 or so in a 12-month time.
Right, well, considering yen weakness at the moment and the potential for strengthen, as you argue, and also fiscal stimulus on the way, how attractive do you find Japanese equities at the moment, and do you even need to be selective?
I think Japanese equity market in US dollar terms is going to be the best market in the world next 12 months. But I don't expect it to deliver absolute performance. I mean it will not deliver positive return. I think global equity market will be selling off. The Japanese stocks will be weak in a local currency terms as a yen strength depress exporters' profits. But however, in a common currency terms, I believe Japanese market will outperform other markets that will be down quite meaningfully over the next 12 months.
Are there any particular sectors or names in Japan that you would favor at the moment?
I think there's a macro regime shift in Japan is going to happen very soon. As exports contract and Japanese yen strengthen, it will cap Japanese interest rate. Bond yields will drop a lot, and investors should favor interest rate plays in Japan versus exporters. Exporters are facing weak, strong yen, weak global demand, while interest rate sensitive sector will benefit from bond yields coming down substantially. So overweight interest rate sensitive sectors and underweight exporters.
Considering your case for US dollar weakness heading into 2026, does that make emerging Asian markets attractive to you as well?
I would overweight emerging Asian market versus S&P 500 in common currency terms. In US dollars, emerging Asian market will outperform S&P 500. In fact, I believe S&P will be the weakest equity market in the world in a dollar term. Partially, it will be weakness in a dollar, quite substantial weakness in a dollar that I expect. Also, it will be pullback in technology sectors, underperformance of tech globally. So emerging Asian markets overall will outperform S&P, but they will underperform Japanese stocks in common currency terms. And they will be down in absolute term because S&P, the global risk appetite setter, U.S. equity market will be down.
Okay, so you're negative on the S&P and the US dollar as well, but does your opinion of the S&P change when you consider that perhaps we're looking at a couple of Fed rate cuts into next year as well?
Not really, because my view already incorporates that Fed will be cutting interest rate by more than 2 times. I think Fed will be cutting at least 4 times next year, and equity weakness will encourage and lead Fed to cut interest rate by 100+ basis point next year, but that will not prevent U.S. stock market from selling off.
Okay, well, specifically around emerging markets, I'm wondering what your investment approach to China is at the moment.
I think Chinese stocks last 12 months rallied substantially due to AI story. Tech names in China have rallied a lot. That has been supported by a rally in US and global tech. However, if we look at the profits performance of Chinese tech companies, it's not impressive. Outside of a couple of companies like Tencent and NetEase, most of tech plays in China have not delivered any profit growth. In fact, many of them have seen their profit margins decline. They have seen their profit stagnate, and top line growth has been quite weak. So as global tech stocks pull back, Chinese tech companies will go down too. So at this point, we're neutral on China within emerging market or global equity portfolios, because Chinese economy is not going to recover, and Chinese stocks are going to give some of the gains of this year due to sell-off in global tech.
Well, Bloomberg Intelligence is forecasting some easing in China next year. Are you expecting to see anything on the fiscal or monetary side?
Yes, I think economy will disappoint as exports contract, and exports have been one of very few bright areas of economy. So I'm looking for very weak growth, persistent deflationary pressures, and of course policymakers are going to introduce more stimulative policies, cut rates, a bit of fiscal stimulus, but nothing substantial to create cyclical recovery. So Chinese economy will not recover cyclically. Profit growth will not recover. Yes, I'm projecting policy easing, but not substantial to drive trigger cyclical recovery. And the key fact is that China remains in liquidity trap. And liquidity trap is conditioned when interest rate cuts don't work. So monetary policy is not effective. And we find China in that conditions now.
All right, Arthur Budaghyan of BCA Research is sticking around. And when we come back, we're going to get some more insights on commodities. Gold setting its 50th daily record this year. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Oil prices are holding on to a 4-day run of gains as the US continues its blockade of shipments of crude from Venezuela. President Trump says the US will keep the oil from the ships it seized as he intensifies pressure on Nicolas Maduro. Venezuelan oil exports represent less than 1% of global supply, but the revenue provides a financial lifeline for the Maduro regime.
He can do whatever he wants. It's all right. Whatever he wants to do. If he wants to do something, if he plays tough, it'll be the last time he's ever able to play tough.
Well, metals traders are also weighing geopolitical tensions. Gold hitting its 50th daily record high this year. Metals and mining reporter Martin Ritchie joins us now with more. Martin, gold, silver continuing to perform extremely strongly. If I didn't know better, I'd say this is the apocalypse. So what's driving this?
Yeah, it's been quite a year for the precious metals and gold in particular, now up more than 70% this year. As you just alluded to, like 50 days of breaking records this year. It's just a function of it really breaking record earlier in the year and then keeping on rising throughout the year pretty steadily. What's going on? This year have been a lot of geopolitical tensions, there have been worries about bank balance sheets, and there's obviously been trade tensions and monetary easing with the Fed continuing to cut interest rates. More broadly, I think there's a sort of sense that the sort of financial architecture that we've been used to for decades is starting to kind of fracture a little bit, and that's pushing central banks in particular towards gold, and purchasing by central banks has really underpinned the rally this year and probably will continue to do so. In terms of private investors in gold now, that's sort of the interesting one for next year, because the holdings in exchange-traded funds, which is the typical way for private investors to expose themselves to gold, are actually not that high compared to the peaks they were at during the early years of the pandemic. So there's really a lot more space still for investors to move into the gold space, and that's one of the reasons why you've got a lot of the banks still being very bullish, despite the price action we've already seen this year.
Well, we're seeing bullish price action in copper as well, which is usually a sign that the economy is running pretty well. So what's driving this spike?
Yeah, you're right. It is normally a sign that the economy is running pretty well. But in this case, I think it's definitely more supply-driven than demand-driven. And that's why there's a little bit more caution, I would say, when it comes to copper being at record highs than versus gold. In copper, what you've seen is, try to put this as simply as possible, a lot of traders rushing metal to the US before Trump puts import tariffs on. And that's tightening the market elsewhere. You've seen inventories falling sharply elsewhere. And a lot of people expect this trade to continue throughout next year until Trump makes a decision, perhaps in the middle of next year. And in that context, that means that this rally is a much more specific driver rather than demand, which in copper actually is still globally relatively quite soft.
All right, metals and mining reporter Martin Ritchie there. Well, Arthur Budaghyan, Chief EM Strategist at BCA Research, is still with us. And Arthur, I just want to pick up on the commodities theme here and what Martin was saying in terms of copper. It's approaching $12,000 a tonne now, but as he said, looks like it's supply-driven. How enduring do you think this rally is going to be?
I think historically copper prices cyclically were correlated with global manufacturing cycle. However, in the past 12 months, manufacturing cycle has been soft, but copper prices rallied a lot, mostly due to supply issues, idiosyncratic issues related to tariffs, and we got a closure of a couple of very large mines around the world producing copper. So it's not surprising that copper benefited from supply shortages or supply shocks. However, demand remains weak and will remain weak for next let's say 9 to 12 months. So when there is a more clarity, visibility with U.S. copper import tariff, copper prices will pull back meaningfully.
So would there be any stocks that you'd be looking to take advantage of this short-term rally, or would it be more tempting to short some of those copper miners?
I think we should try kind of there's a long-term tailwinds for copper, structural, multi-year, from green energy and lack of supply in the long run. And there is a short-term kind of weakness, cyclical weakness ahead. So I would say when you have structural forces pointing in one direction, cyclical forces in another direction, it's dangerous to be short. I think there will be better short opportunities elsewhere if kind of a global business cycle starts weakening, as I expect. Shorting other commodities, other metals will be much better trade-off, like platinum, like aluminum, and so on.
Arthur, would you put silver into that category as well? Because it's certainly no stranger historically when it comes to short squeezes, speculation as well. And if we take a look at this chart, the upside for silver has been quite phenomenal. How much longer do you see this running for?
I think a rally in a silver, it's quite speculative. One underpinning that gold has, it's a central banks around the world, and specifically Chinese central bank buying gold, diversifying its foreign exchange reserves. There's no any evidence to say that Chinese central bank is buying silver. So I would say a rally in a silver, it's on weaker fundamentals than a rally in a gold. So I would be favoring gold over silver. And if gold, let's say, pulls back down 5%, silver can sell off 15-20%. So I would avoid chasing silver higher from this point of time.
Well, let's take a look at gold as well, because it's given us all sorts of interesting statistics to take a look at. And one of those is this chart. It shows gold tracking U.S. debt as well. Do you have a sense that maybe the gold price is sending a warning about the sheer size of that ever-growing U.S. debt pile?
I don't think U.S. government is going to default on that or anything like that. U.S. will inflate and devalue its way out of its public debt. And that's why, as I said earlier today, the trade for next year in a global currency market get out of dollar, GOD, which means U.S. is going to devalue dollar, try to inflate its way out of that. And one way would be to bring down real interest rate. And you see what U.S. Treasury Secretary Bessent and Trump have been trying to do, push Fed to cut interest rate, to depress long end of a yield curve. It's all policies pointing to they target to bring down real interest rate in U.S. So, and eventually I believe they will succeed. Real interest rate will fall and gold will benefit from that. So I think gold will go up even though there is no public debt default or something like that in U.S.
All right, Arthur Budaghyan bringing us full circle, Chief EM Strategist at BCA Research. Get out of dollar, he says. Still to come, we're going to get the market outlook with Sumitomo Mitsui as bullish momentum in global equities takes hold during the shortened holiday trading week. And we'll break down hopes for a ceasefire between Cambodia and Thailand with the ISEAS-Yusof Ishak Institute. More to come in the next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We are seeing this modest rally continuing on most of the major Asia-Pacific benchmarks. We've got all the major indexes in modestly higher territory. The Kospi better by 0.25% there. The Nikkei flat after coming back from its lunch break. We do have the yuan at its strongest level in China in 14 months. This is buoyed by gains in local stocks as well. And we have again seen some modest gains in Chinese equities today. The Indian rupee still holding on reasonably firmly below that 90 rupee to the dollar level, and gold setting another fresh record, that is 50th fresh record of 2025. Well, Fed Governor Stephen Miran says the central bank risks sparking a recession unless it continues lowering interest rates next year. He told Bloomberg that data on housing costs was impacted by the government shutdown.
It is true that the shelter stuff was somewhat distorted by some of the quirks of recovering from the shutdown. But it's also true that the shelter data were distorted for most of the year because of really long lags with which shelter inflation is calculated. If you look at market rents, they've been running at about a 1% rate for about 2 years now, right? That's not indicative of any price pressures in housing whatsoever, but it takes a really long time for measured shelter inflation to catch up to that, just because of various quirks of the statistical measurement process that I got into in my speech last week. So I do think there was maybe some downward bias in last week's print, but at the same time, there's been tons of upward bias in data for the entire year, and it's inappropriate to say, okay, well, we have to adjust for the downward bias, but we're going to accept the upward bias. That itself is a deeply biased position. We've got to be clear-eyed about both.
Well, do you feel like, and yourself included, but do you feel like members of the Fed are cherry-picking what about inflation they like or dislike?
Well, I mean, I think that for the last few months, we've had data come out in accordance with, I think, my view of the world. The inflation data have steadily come in cooler than expectations. The unemployment rate has poked up, potentially above where people thought it was going to go. And so we've had data that should push people into a dovish direction. And I think it's somewhat problematic if you see those data coming out and you don't adjust your policy prescriptions in a dovish direction. What does that say about the reactiveness of policy to the economy? I think it reflects very poorly upon the institution.
At the end of that speech at Columbia, you nodded to the fact that recessions are inevitable. Fed's job is to kind of forestall them as much as they can. Policymakers' jobs are that. I'm very curious, when you look at the labor market in particular, the rise that we've seen in the unemployment rate, that's kind of rise we've seen customarily before recessions. How do you assess the risk of there being a recession here in the near term when you look at the labor market, for instance? So I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions. I don't think it's too late to prevent that, and so I think it's important that we keep on adjusting our policy rate down. But at the moment, it's not my base case, in part because I think that we ultimately will end up continuing to adjust interest rates down.
That's Fed Governor Stephen Miran there. Let's get some more on markets with Jeff Ng, head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. And Jeff, I just want to pick up on some of the remarks that Stephen Miran was making there, warning of recession risk if the Fed doesn't ease. Well, also this week we heard from Cleveland Fed Beth Hammack, who was putting the case for a pause because of inflation risks. So did my colleague have a point? Are Fed officials cherry-picking inflation data that they like?
Yeah, I think when we look into the current economic data, inflation looks like it's softening, but there's always a threat that it could rebound. And then at the same time, I think there is some hint of a slow economic slowdown due to the government shutdown. So I think overall what we are still anticipating is of a muddle through in the global and the US economy, where we see a modest slowdown. But I think markets will still be fairly buoyed by the fact that the policy support will be there, both the fiscal and the monetary measures. I think that will be continuing to be supportive of markets going forward.
When do you feel the next live Fed meeting is, assuming that January is going to be a hold most likely?
Well, I think March could be the time frame where we see more clarity because we will have most of the economic data that's delayed and likely to come in the coming few months. And I think we will have a much better assessment in terms of the updated economic projections and the dot plots, which may then warrant more adjustments if needed.
Well, we are also at risk of another potential shutdown in the US at the end of January. I mean, if we get another few weeks where there's patchy data, how difficult will that make the Fed's job for potential easing in the second half?
Indeed. I think when we look into the current dot plot as well as how the various members have been talking, I think what we see is that there's certainly a divergence in terms of the perspectives. So with some potential distortion in the data, it could still mean that there could be concerns, and with a dual mandate from the Fed, that could complicate matters as well. But I think we firmly believe that there could be more rate cuts coming in, and I think it could come in as early as March, and perhaps after, in the second quarter and thereafter, once there's a new Fed chairman and committee, we could see more moves along the way.
If we look back on 2025, I've got to say the market didn't really do a terrific job when it came to predicting and pricing in Fed easing. And we have some data here that suggests maybe central banks might not be as dovish as expected come 2026. How realistic do you think it is that maybe the market's going to get let down again on the easing narrative?
Indeed, I think markets are focusing on different aspects in different months, and I think one major key theme that we have for 2026 is that things will look pretty uneven. So perhaps while the numbers may be positive or negative overall, but there will be sectors, for example, AI, which will continue to propel markets. There will be other laggards along the way as well. So I think that will mean that I think while people focus on the whole average and markets may cherry pick, but for us, I think overall we are still seeing some potential slowdown overall, which may then lead to more easing.
You mentioned a minute ago that next year we're going to get some new governors, a new Fed chair as well. I'm just wondering, who's your pick for Fed chair? Who do you think the new governor is going to be, or the new Fed chair is going to be? And do you worry at all that there might be some question marks over Fed independence?
Well, I'm sure that is a very interesting question on who the next Fed chair governor will be, and I certainly will be privy to any of such information. I think what's very interesting to me is that how this new Fed chair will unite the various opinions from the members, because we have seen some being more concerned about inflation, some thinking that the policy rate should be maybe even higher than current levels, where there are others who are thinking of more rate cuts along the way. And I guess with a dual mandate and with very uneven economic trends, both on the employment and the inflation front, I think it's going to be a tough job for whoever takes over.
In terms of Fed independence, I'm just wondering if you'd agree with this thesis. I mean, the bond market sent a pretty strong message around the Liberation Day tariffs, which forced something of a back down. Would you expect the bond market to send a similar message if it gets a sense that the Fed's acting in any other way than just relying on data?
I think one major key risk that we are concerned about heading into 2026 is that while in a muddle-through scenario, and while there's some broad support from both the fiscal and the monetary front that will be supportive of markets, we still watch for risks of policy mistakes, and whenever markets interpret things being uneven and messy, I think that could trigger some market correction and some market concerns as well. And given how volatile it has been in 2025, certainly there's some possibility that it could happen anytime in 2026 as well.
Our guest last hour was saying his number one trade for 2026 is GOD, get out of the dollar. Would you share a similar bearish sentiment for the greenback next year?
For me, I still expect a firm dollar, although it will be weakening in our view. by about 2 to 3%. And I think some currencies will strengthen more against the greenback, others may be more stable. So our picks, I think, is for some rebounds, especially after very weak positioning for instance, for the Korean won and the Taiwan dollar. And I think we remain quite positive on some Asian currencies like the ringgit as well as the Singapore dollar due to positive fundamentals. So I think next year it will be a mix of fundamental and positioning play for us.
All right, Jeff Ng of Sumitomo Mitsui Banking Corporation is sticking around. Up next, China Vanke averts default with a last-minute reprieve from bondholders, but $1.3 billion of debt is still at risk. We'll take a look at what's next for the embattled developer. That's next. This is Bloomberg. Welcome back. You're watching Insight. Property developer China Vanke has secured last-minute support from creditors to extend a bond grace period, a reprieve that helps it avoid default, again, at least for now. For more, let's bring in Lian Ting Tu, our managing editor for Asian Equities. Lian Ting, another extension. Do we have any more details from that bondholder vote? And when are we going to be doing all of this again?
Yeah, the extension is only on the grace period, extending to January 28th. So buying Vanke a little bit more time to renegotiate some terms with the bondholders. The bondholders, to be sure, rejected the extension on the maturity payment by 12 months. So that is basically not boding well for Vanke. And now all eyes are on another bond, which is regarding a 3.7 billion yuan bond that is maturing on December 28th, which is 5 days from now. There is again going to be a bondholder vote on that particular bond on December 25th, Christmas Day, on whether to extend maturity for that bond by 12 months. And it's very likely that the bondholders are going to reject that. So it all comes down to whether there is an extension on the grace period or not. Overall, we are looking at a holistic restructuring on all of its $50 billion bonds sooner or later.
Yeah, is default inevitable, and what is the downside to just defaulting here and being done with it?
Well, it's still a very big developer. It used to be the largest developer in China. I think it also still employs 125,000 employees. So overall, I would say still a very large company that has implications on China's economic growth and employment. So letting it default, it's probably not a great option, but it is an inevitable outcome because the bonds are already trading at about 20 cents on the dollar. So people are looking at a very low recovery for the assets.
Is there any white knight on the horizon for China Vanke? Could we have an unexpected twist in this story?
Well, that's anyone's guess. But so far, the state backer, Shenzhen Metro, is really stepping away, at least not committing new resources. So from that perspective, I think the question is, are we going to see a little bit more money from the company or from from the Shenzhen government? And also the fallout, I think, is about overall sentiment hit on investors in the real estate sector in China, and also the continued dampening effect on the consumer sector because the majority of China's household wealth is still very much tied to the real estate sector.
All right, Managing Editor for Asia Equities, Lian Ting Tu there. Staying on China, renewed interest in the country's AI hardware makers is helping mainland markets outperform their offshore peers, and analysts say the momentum may continue amid ongoing policy support for the sector. So for more on this, let's get to Asia Equities reporter Sang-Mi Cha. So Sang-Mi, tell us some more about the rally that we're seeing here.
Right, that's right. So onshore benchmark CSI 300 is heading for gains in December after 2 months of losses, whereas the Chinese stock listed in Hong Kong is extending its declines. And the reason why we're seeing this is not because of that broad recovery, but more of the handful of listings of these AI chip makers that is single-handedly just boosting this onshore benchmark. And we see that because Beijing has a huge support that they came up with. They're mulling $70 billion worth of incentives to bankroll these chip industry. So the market is buying this whole policy drive, and they're saying that there's no way that these companies are going to run out of cash to fund and fuel these R&Ds that they are coming up with. So we have seen so many of these new listings onshore, including the MetaX and more Threads, and a lot of these new listings are just coming to town, and that is buoying the market onshore.
So, Sang-Mi, which stocks are benefiting the most at the moment, and is this rally really sustainable?
So other than the two blockbusters that we have seen, there are a few other GPU makers, including Inflame Technology and Birentech that we that just talked about their listings yesterday. So and we are seeing the broadening out of these listing spree from the headline IPO names into more of these wider AI hardware names. So we're talking about the Optolink Technology and just other hardware names that are within the AI supply chain. And this all comes from this whole drive, not just the money part, but the regulatory action. So Beijing is actually easing some of these listing rules for these companies so that it's easier for these companies to go public and raise funds. But at the same time, they're making it easier for the approvals so that these companies can be approved as growth companies within Chinext. Now, whether this rally can continue, that remains to be seen. Of course, a lot of the companies are loss-making still. But again, because there is that huge support from the government and also just a big interest within investors who are trying to bank on this AI frenzy, a lot of the analysts say that the downside risk is quite low here.
All right, Bloomberg Asia Equities reporter Sang-Mi Cha. Well, Jeff Ng is still with us, head of Asia Macro Strategy at SMBC. And Jeff, I just want to pick up on some of those themes that Sang-Mi and Liang Tu were talking about. I mean, do you get a sense we're seeing the emergence of a K-shaped economy in China now? On the one hand, we've got property which just seems to be sinking ever deeper into the mire, and then on the other hand, so a lot of strength around the AI story. So do you feel that AI can, in a way, ride to the rescue of China's economy and consumer confidence as well?
Well, when we look into the current economic trends in China, it does look like the domestic demand is still looking pretty stable at this stage, while China growth is primarily still supported by external demand, with export growth and the trade balance still relatively supportive. And I think next year, this unevenness, in our view, may still continue on the fact that we will see more adoption in AI. We are relatively optimistic on AI fundamentals for 2026, and I think that will continue to propel the demand for some of these China products, which are starting to proliferate, not just around the Asia-Pacific region and also globally. So I think that's one area that we are really positive on China exports.
I want to return to the AI theme in a moment, but first I'd just like to get your views on the risks around the property sector, because China Vanke has another bond coming due this week. If it were allowed to fail, if it were allowed to default, what scenarios do you have in mind in terms of contagion risk?
Well, for the time being, I think for the rest of the year, as well as for 2026, we will still anticipate that the sort of like China economy, as well as the whole world trudges along. But of course, there's going to be event risks that are littered along the way. And as you can see, there's plenty of dates for all these repayments. And I suppose that there will be a lot of negotiations along the way. So if that does not turn in the successful scenario, I think we may see some sort of like more negotiations along the way. But I think my base case is still for the current situation to be relatively contained, and I think the contagion risk, as you mentioned, will likely still be fairly muted at this stage. So I'm not expecting it to turn more broad-based.
Of course, the fortunes of the property sector very closely tied to consumer sentiment in China as well. What's your expectation around consumer confidence in China next year?
Sure. Yeah, when we look into consumer confidence, I think there are two components. I think one is the equity market, which has rallied a lot this year. But if you compare to levels seen in 2020 or 2021, they are still comparable or slightly down. And then at the same time, I think the real estate continues to be a bit of a soft spot, a bit complicated at this stage. So I think if the equity market and the overall sentiment from AI, I think, continues to be supportive, I think that could help with further rebounds in the equity space. And I think that could be fairly supportive of the overall sentiment in China, because while the real estate continues to look soft, the equity market climb, and I think some of the sort of like consumers may then feel that this may help with some of how they are looking at in terms of wealth for the outlook for 2026 and beyond.
Yeah, well, on the upside, earlier this month we did have that stunning debut from More Threads, and it unveiled some new chip designs this week as well. So when you look at the AI landscape in China, how encouraged are you? Would you be a buyer in this space, considering they are loss-making concerns, but they are also backstopped by the Chinese government?
Yeah, I think overall, when we look into the whole AI space, the markets have gone and climbed, and at the same time, I think we think that the adoption will still be fairly uneven at this stage. So there could be some periods of time where the progress stalls, and there's going to be other periods where growth is going to be accelerating. So all this divergence between market expectations as well as fundamentals may mean that there could be some scope for correction on some days, and then on some other days, I think the sentiment will still improve. But I think overall, while the concerns of, let's say, overcapacity or competition may persist, but I think we are still scraping the surface in overall adoption, and I think that could mean that there will be increased demand for goods and services that could range from the chatbots towards driverless cars and AI robots, for instance, just to name a few. And I think that will be where we are very optimistic about in the medium term.
Jeff, I just want to quickly get your views on the yuan as well before we let you go, because I mentioned when we were looking at markets before, it's at its strongest in 14 months now. What is your outlook for the yuan in 2026?
I strongly believe that they will climb below, the dollar CNY will go below 7 next year sometime. And I think the fall will be relatively sort of like gradual, even with some supportive factors for yuan appreciation. But I think the authorities will still want to see some stability. So that will be perhaps manifested in the daily PBOC CNY fixings, which will then anchor at the sort of like official policy stance towards some strength for the yuan against the US dollar, but not excessive, to anchor at a kind of a supportive environment for China exports as well as for China domestic demand.
All right, Jeff Ng, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corporation. Thanks so much for joining us today. Coming up, Thailand and Cambodia head to the negotiating table to discuss ceasefire terms after their latest border clashes. We'll get the analysis of that situation next. This is Bloomberg. Welcome back. You're watching Insight. Cambodia and Thailand have agreed to meet on Wednesday to discuss conditions for a ceasefire in a fresh bid to end deadly border clashes between the two neighbours. Let's get to Bangkok now and our reporter Pat Picha Tanaka Sempipat. So, Pat Picha, what is the latest on these ceasefire talks?
Paul, at yesterday's meeting of the ASEAN foreign ministers, Thailand and Cambodia agreed to hold talks tomorrow to discuss new ceasefire terms and how to implement them. Although this is far from a guaranteed outcome, it's not certain that they will come to an agreement tomorrow or later this week. But the fact that the two countries were able to set a date for talks is already a breakthrough since the clashes restarted earlier this month. The talks will this time be between the military commands in each country that are in charge of securing the border and fighting along the border area that the two countries shared, and this will not be a discussion between the countries' respective governments. Thai Foreign Minister Ishak said yesterday that this is really important that the two militaries sit down and really thrash out the details of the new ceasefire so that we can make one that will really hold. And he says this approach is likely going to be better than rushing out a joint declaration of peace, very much like the one that was pushed by President Donald Trump in July. Only for it to break down later, Paul.
So tell us what we know about Thailand's conditions for these talks.
Sure. Thailand has made very clear that it has three demands for Cambodia to meet in order for peace to be restored and a ceasefire agreement to be reached. And that is that Cambodia must first announce a ceasefire, and that ceasefire must actually materialize, and that Cambodia must agree to cooperate on joint efforts to remove landmines. Now, the reason we're talking about landmines at all is because this is a very big issue for Thailand. After Thai soldiers have been maimed and injured in 8 landmine incidents actually since July. And landmine removal is one of the conditions for ceasefire that Thailand has put forward. And the landmine blasts that have happened since July have actually marked key escalation points between the two countries' conflicts that started again in December. Now, Thailand said that the mines were newly laid, but Cambodia said that the mines were actually remnants of an old civil war, a past civil war in the country, and that Thai soldiers stepped on them because they had ventured into Cambodian territory. If the talks are successful, we might see the two countries return to observing the terms of a ceasefire and the peace deal that was pushed by President Donald Trump in July, and that would include steps to withdraw troops, withdraw heavy weapons from border areas, as well as remove landmines together in order to de-escalate tensions along the border.
Tell me, how much public support is there in Thailand and Cambodia at the moment for pursuing a peace deal?
I think tension internationally is growing, especially from the U.S. and China. Both countries have made calls as recently as this week for Thailand and Cambodia to reach peace terms and to agree on going back to the peace declaration from October. Domestically, Thai Prime Minister Anutin Chanvirakul has come under pressure to take a harsh stance on Cambodia conflict, actually. And ahead of an election that's coming up in February, he has taken a tougher stance. He has used pro-military rhetoric in order to try to boost nationalist support. The tension with Cambodia, it has been fueled nationalist sentiments in the country, especially ahead of elections. So, but the border areas, the 7 provinces that are engaged and involved in the conflict zones have come under a lot of duress and stress, and pressure is also growing for Anutin for the Thai government to reach some sort of deal in order to cease the fighting, as well as resume border trade, which has been really vital to those provinces' economy.
All right, Bangkok Bureau reporter Pat Picha Tanaka Sempipat there. Thanks for joining us. Let's get some more on the situation with Dr. Pongkwan Sawasdipakdi, visiting fellow at the ISEAS-Yusof Ishak Institute. Dr. Pongkwan, thank you so much for joining us today. I just want to pick up on some of the points that were being made there. We've got both sides back at the negotiating table today, but considering there can't even really be agreement on whether some of the landmines in the area are newly laid or have been been there for some time. How many sticking points and how realistic is it that we're going to get a durable ceasefire here?
You're right. There are a lot of facts that two sides cannot really agree on. So the negotiation, I think, would probably take a long time for both sides to agree on, especially when we are actually having military officers joining the negotiation rather than, people from foreign ministries. So if there is an agreement at all, it might be more stable than last time, but we also don't know whether they can actually reach any outcome by the end of tomorrow's negotiation. It will be hard. But at least one thing that's good for having this type of bilateral agreement is it allows two sides to actually talking face to face with each other rather than passing each other in the media, right? And one thing that I think will be really important is this type of negotiation will allow both sides to declare ceasefire bilaterally. So for the Asian context, face saving is really important, right? So both countries would not really want the other side or our side to actually declare the ceasefire first. However, this might be a condition as well, as the Ministry of Foreign Affairs, Ishak, has actually said that the Cambodian has to be the one who declared the ceasefire work. We don't know how would this work out technically when both sides also want to save the face in this issue.
Now, there was a ceasefire signed back in July 29, but Thailand's foreign minister says that was rushed and it lacked detail, and rather strikingly, he says that was so that US President Trump could attend an October signing ceremony. Is that a reasonable criticism?
I think that's reasonable criticism. It was rushed. It was actually without a thorough negotiation between both sides. To me, it looked more very performative. Both sides it was an opportunity that Donald Trump was actually in Southeast Asia. Both sides wanted to show that they have committed to something that was demanded by President Trump, right? And at the end of the day, Thailand, for example, received a rare earth deal that we signed with Donald Trump back in July when we declared a ceasefire and signed a deal with Cambodia. So to me, that time, the ceasefire was really rushed. It was actually not negotiated thoroughly. It didn't really come really purely by both sides, right? There were actually external pressures, and there was also an incentive to perform this because of the benefit it could get in terms of trade with the United States, right? So this time, hopefully it comes really sincerely from both sides without the involvement of external parties as claimed by the Thai party. This might actually represent another step in resolving the issue between Thailand and Cambodia.
Yeah, is there a further role for the US in ending this conflict, perhaps linked to trade outcomes, or is there going to be a more durable outcome if this is driven by ASEAN nations?
So from my observation of the general public sentiment and also something that's coming out from the government, it looks like it's not going to be more durable if this is mediated by the United States, right? For two reasons. I think the first reason is observing, the conversation that's going on in the media right now, both from the public and from the government. It looks like the trade issues, the risk of being punished by the tariffs are not very mentioned much in the media. So they try to separate between the two issues, the security issue and the trade issues. So that's why the media has actually paid less attention on possible punishment that Thailand could get if Thailand doesn't really agree on this. So when the two issues are delinked, I think the U.S. cannot really leverage that much because it doesn't seem that the Thai side cares so much about this issue. And secondly, I think there's a feeling of anti-involvement by major powers. For example, when Anutin actually declares, during the current clash, right, the beginning of this current clash, that he doesn't really care anymore about the tariffs. Now he doesn't want to play along with the pressures given by the United States, and he's ready to just protect the sovereignty of Thai nation. That was actually welcomed by some, public in Thailand, right? So it looks like there's this anti-involvement by major powers, the feeling of being pressured by major powers, and Thailand wants to go, our way, trying to protect the sovereignty. So I think ASEAN might be a better mechanism, if at all. I think judging from the sentiment by the government and by the people right now, Thailand might actually want to do it bilaterally without intervention by any other major parties at all.
As you're speaking there, we are getting live pictures of the Thai Ministry of Foreign Affairs holding a news conference in Bangkok relating to this conflict. We will bring you any news that we get out of that as we receive it. But to your point of preferring to keep these peace negotiations in-house or in the region, we've also had China making some remarks on brokering peace between Thailand and Cambodia. Now, is there a role for China here in ending the fighting, or is that even more difficult to comprehend, considering that China has overlapping South China Sea claims with both Thailand and Cambodia?
I don't think Thailand has an overlapping sea claims with China. However, there's also, I don't think China would be playing a major role here as well. As I said earlier, I think it looks like the Thai side wants to keep this bilaterally and within the region. And also there's another consideration, which if Thailand is allowing China to play a role in mediating the deal, then it has to reconsider a foreign policy as a whole, right? Would this actually look like Thailand is giving more role to China rather than the United States? Obviously, this is not something that Thailand has been trying to portray. Thailand tries to being very neutral party in this geopolitical tension. So if Thailand does not really open a door for the U.S. to play a role here, I don't think Thailand will also do the same for China.
Well, this week, Thailand hit a casino in Cambodia, which seems like a very unusual target. Why did that happen? And do you feel that there is a risk that this conflict could widen and escalate?
So in my perspective, I don't think it's going to escalate further. It's going to be skirmishes along the border as we see, but it's going to be, continuing without the ceasefire. As for hitting the casino, it's actually widely perceived in Thailand that the casino hosts some of the scammer centers. So by hitting that casinos, Thai people perceive that, the government is actually doing something about the scammer problems that are affecting a lot of livelihood of people, and people actually look very negatively towards that scammer centers. So I think the government or the military is doing this for two reasons, right? First is to show the public that it actually cares about, the things or the activities that are affecting their lives. It's doing something about the livelihood of people beyond just protecting the sovereignty. This is also something that could gain popularity for both the government and the army. And the second reason could be that it's widely perceived in Thailand that scammer centers are being linked to political elites in Cambodia. So by doing that, it also looks like Thailand is trying to jeopardize the economic, life veins of the political elites in Cambodia as well, and therefore will make them politically and economically weaker if the tension and the clashes continue between the two parties.
What is the long-term solution to this? Because as I understand it, the border itself was an arbitrarily drawn line by France way back in 1907, back when Thailand was known as Siam and Cambodia wasn't even a country. So how does this even get unraveled in a lasting, enduring way?
So, yes, it is not totally unresolvable, but it's going to be difficult. Let me actually raise an example. Actually, we have an overlapping border with Malaysia as well. Thailand and Malaysia has actually agreed for a joint development zone so that both parties can explore the minerals, the energies and oils that are sitting in the seabed, right? So this could be actually an example for the Thai and Cambodian conflict as well, right? The Joint Development Zone. However, when I said it was difficult, I said it was difficult because the issue between Thailand and Cambodia has actually occupied a very unique space in Thai people's memory. So it's been securitized in a way that we care more about sovereignty over this issue. Also, the sacred land of the Privy Temple and many temples that are sitting alongside the areas that have been weaponized by political elites so many times. And therefore, people seem to think of this border front as more security issues rather than possible economic issues. But if it's, talk about whether we can solve it at all, there's actually always, a solution. We see that in the case of Thailand and Malaysia, but it's going to be really hard politically since the issue has been securitized and being seen as a security issue over, economic and other potential development issues.
Well, there's going to be an election in Thailand early in the new year. I'm just wondering to what degree nationalist sentiment is going to provide a boost to Thai Prime Minister Anutin.
I think it will play a role for sure. I think it will be one of the key issues in the debates among the political, the prime minister candidates from different political parties. We already see Phumchai Thai Party coming out and say that one of their policies could be building a wall between Thailand and Cambodia. So and the nationalist sentiment will actually run high. It's going to discredit sites that are going to be probably more conciliatory in the case of Thailand and Cambodia conflicts. And it's going to be one of the issues that people have to debate about. However, I would have to mention here that not everyone in Thailand is supporting the conflicts, right? There are actually some sector in Thailand that would prefer more diplomatic means. As of now, we actually don't know how much this sector is. We're definitely going to see how people welcome, the debates and comments by different political parties.
Okay, Pongkwan, we are out of time, but thank you so much for joining us. Pongkwan Sawasdipakdi of ISEAS-Yusof Ishak Institute. Coming up, our conversation with New Zealand Trade Minister Todd McClay on the free trade agreement with India. This is Bloomberg. Welcome back. You're watching Insight. New Zealand Trade Minister Todd McClay says more businesses stand to gain investment opportunities in India under a new free trade accord. I spoke with him earlier about the benefits and challenges of the deal.
It is a win-win for both of our countries. It's a very high-quality agreement, as you have said. 95% of New Zealand's exports are covered by some form of liberalisation, and when fully enforced, about 82% of exports will be tariff-free. So we're very pleased with the result. You are right that our trade with India is modest, particularly when you consider the size of India. But New Zealand has a great track record of when we get a trade agreement right and it's balance of both sides, trade increases very, very quickly. As an example, our FTA with the European Union, which entered into force almost 2 years ago, has been worth an extra $2 billion worth of exports for New Zealand in that period of time. And there are comparisons that can be made between the India FTA and some of the areas that we gained with the EU. So we're optimistic.
So do you have some targets in place for how big you could see that trading relationship get within, say, 5 years or 10 years?
Well, our two prime ministers spoke yesterday before the announcement was made to check in. Of course, Prime Minister Modi and Prime Minister Ellison have been engaged during the time that Minister Goyal and I have been negotiating furiously for just 9 months. It took 9 months to get this deal done. They set a target for us of saying we could double the amount of trade we have over the next 5 or 6 years. And I think that's more than possible. Indeed, if you look at the Australian FTA that was done in 2022, over the first 2 years, the Australian exports grow by almost 130%. So actually, I think that once we get this in force, there are big opportunities for the Indian producers in the New Zealand market, and certainly for New Zealanders who produce high-quality goods and services. We will be working hard as two governments to make sure the benefits of the agreement is delivered both for India and New Zealand.
Well, you mentioned that there's a lot of things, 95% of trade covered in this agreement, but we do have to talk about the 5% that's not, because it is important. Dairy, an obvious omission. But was getting India to come to the table on dairy realistic, considering India's trade minister had said that this was never going to be an option for any free trade pact with anyone?
Well, look, we're aware of the sensitivities and political reality of a lot of the things that New Zealand might produce. You mentioned earlier that, that New Zealand not having as much dairy in the agreement as we'd want is a big challenge. The New Zealand economy is much more than dairy farmers. You are right that dairy is a very big part of our export profile, but to the sheep and beef farmers, or sheep in this case, and to wine and to our services trade, this is equally a valuable agreement. We are pleased in some of the high-value dairy or dairy adjacent areas we have been able to make inroads, and our exporters are very pleased about that. But you are right, they would have liked to have seen more. If you take our number one trade relationship, which is China, when we signed a free trade agreement with China more than 20 years ago, our trade was very modest, very similar to the amount of two-way trade we have with India now. All those years forward, it's now 40 billion New Zealand dollars. And if you take dairy out of that equation, China would still be our number one trading partner. And so there is many opportunities in this market very broadly in our economy.
Well, is this a possible way? Because I understand there is a fast-track arrangement within this deal allowing Indian manufacturers to import products and then re-export food products. So is this a potential way to get more New Zealand dairy products into India?
Well, it's very interesting, and that's something that our dairy exporters have welcomed, and they see potential there. It will take a little bit of time for them to form those relationships. But you think about India, they are the world's largest dairy producer. They probably have the largest number of dairy farmers, very small number of animals per farm or per farmer, whereas New Zealand is probably in the other direction. And so we know that Indian manufacturers who want to export to around the region, to countries that they have FTAs with and further afield, are looking for the highest quality and highest value dairy in the world, and you don't get many places better than New Zealand when it comes to that. So I think there are some big opportunities there. This free trade agreement is very forward-looking. It's not about the tariff savings on what we may trade at the moment. Our trade is modest. It's about potential and what more can be done.
Well, of course, your government's coalition partner, New Zealand First, its leader Winston Peters, who's also the foreign minister, has said he won't back this deal because it didn't achieve enough. So when it comes to ratifying this and getting it through Parliament, where are you going to go to get the support to get this done, and how confident are you in doing that?
Yeah, look, there are very few people in New Zealand who are surprised by the position that New Zealand First, one of our coalition partners, has taken. They've always had a view of trade and some challenges with it, although Minister Peters is very committed to the relationship with India and building it. Ultimately, for the last decade, trade in New Zealand has been bipartisan. And in the last 2 years, since I've become minister for my second time around, we've had two trade agreements we've put through our parliament, and it has had almost universal support across our parliament. We'll be talking to other political parties and saying that if trade is good to New Zealand, which we all accept, this is a high quality trade deal, and we would want as much support as we can get in our parliament. But as an example, the EU FTA and the UAE FTA, which we passed into law last year, had a supermajority in our parliament. Some parties may not like all of this agreement, but I don't believe we'll have a challenge getting this into law.
Before we go, here's a look at tomorrow's show. We wrap up the year in markets with Javelin Wealth Management, Automobility and China Great Wall Securities will also join us to discuss the future of EVs. This is Bloomberg.